position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses.
Yeah, we think the best way to minimize risk is to think. And the idea that you have, you say, I've got 60% in stocks and 40% in bonds, and then have a big announcement, now we're moving it to 65-35 as some strategists or whatever they call them in Wall Street do. I mean, that has to be pure nonsense. I mean, 60-40 or 65-30, it just doesn't make any sense. Much of what you see when you talk about asset allocation, it's just merchandising. It's a way to make you think that if you don't know how to determine whether it should be 60-40 or 65-35, that you need these people. And you don't need them at all in investing. I mean, most of the professionals that tell you you're going to get in great trouble unless you listen to them and adopt and sign up for their services, they're good at selling, but
you see, one of the things that Warren Buffett said was he doesn't believe in the whole asset allocation model. And one of the things he said was he just wants to have his money operating in decent businesses. And that's one of the biggest keys. People say, well, you can't just invest in individual businesses. It's too risky. But for the past 6 or 7 years, I've only owned individual businesses. See, I study from and learn from the great investors, not from the people who sell products. So you can tell how your portfolio is actually doing by the results that you're getting. So for my results from 2016, December 31st, 2016, up to July 25th, 2023, you can see that my portfolio is returning 19.44%, whereas the aggressive benchmark is 10% and the S&P 500 is 13.48%. And I'm not doing it because I'm trying to follow some asset allocation model. I'm looking for great businesses to invest in, to buy, to own, and to allow management to run the company. It's almost like being a silent partner with the businesses that I own. The second thing he said was that most of the time when you talk about asset allocation, it's just merchandising. It is the advisors or the money managers selling you products or selling you an idea of how money should be allocated, so that once you leave that allocation, then your portfolio has to be rebalanced and money has to be moved around, which are detrimental to the whole aspect of compounding when owning a great business. And also, once the money is allocated or once the money moves around, you lose that process of compounding. Plus, it comes with fees, transaction costs, and commissions, none of which benefit the individual investor. Also, he said that the merchandising aspect of it, it makes you think that you need these people. You don't really need people at all in investing. You don't need someone to quote unquote manage your investments. I always use the example of Apple. Like, I've owned Apple now for 7 years, the company or the stock, which all stocks are just pieces of businesses. So I don't have to worry about anybody managing my money that's invested in Apple. That's what the CEO of Apple, Tim Cook, is for. His job is to create value for shareholders. So I don't have to sit and think, as long as I can look at the company and know that the company is still doing well, the business. I don't care about what the stock does on a short-term basis, about the stock price going up and down, because I didn't buy it with the intent on selling it. I don't get up in the buy low, sell high, move money around. I need to have this amount allocated here, this amount allocated here. I just want to own great businesses. And when you own great businesses, your portfolio can only create a return in a manner that's consistent with the businesses that you own. So if you own businesses that grow at 15% a year or 20% a year, that's how your portfolio is going to perform. So you have to seek and learn what makes a good business, and then only look for the outstanding businesses. It becomes so much easier for us as individual investors if we can identify great businesses and just own them. Just own them. And just know that most of the professionals are really good at selling. So don't become a victim of the salesman if the results aren't matching. If you are paying somebody to manage your money and your money is compounding at a rate less than the index is doing, then you're wasting your money. You should not be paying somebody to get so you can have less money than you would if you did it your own just by buying an index. All right? So, asset allocation, something I don't do. I learned this from studying Warren Buffett, also from reading Philip Fisher, and some of the great investors who really don't talk about asset allocation, but they talk about owning the best businesses. Just buy them, own them, let management run them, and then you can reap the benefits for your money compounding at a high rate. That's what's important. How long can your money compound? Not trying to beat the market this year, not trying to beat the market last year, but how does your money compound over a long period of time? That's what wealth is built. Over 5, 10, 20, 30 years, just letting your money compound. All right? So have a good day, and I will talk to you soon.